Welcome back to Build Wealth Now News, everyone. I'm your host, Billy Bob, and we are live right now. Tonight, we're diving into a stock that's been quietly powering the AI revolution behind the scenes. Flex Ltd, ticker FLEX. Is this manufacturing powerhouse still a buy after its strong run? To break this down methodically, we have our market analyst, Sarah, in the studio. Sarah, welcome.
Thanks, Billy Bob. Great to be here. And to our viewers, we're not just throwing out hot takes. We're running Flex through our comprehensive 6-part analytical framework. Business phase, business model, competitive moat, growth drivers, phase-specific metrics, and valuation. Let's get into it.
Perfect. Let's start at the very beginning for viewers who may not know. What does Flex Ltd actually do?
Great question. Flex is a global manufacturing solutions provider. Think of them as the behind-the-scenes partner for the world's leading technology companies. They don't sell products under their own brand. Instead, they design, engineer, manufacture, and manage supply chains for other companies' products. They operate through two main segments: Flex Agility Solutions, FAS, which handles flexible, high-mix/low volume manufacturing for emerging products, and Flex Reliability Solutions, FRS, which focuses on high-volume, complex manufacturing for established products like data center infrastructure, automotive systems, and industrial equipment.
So if I buy an AI server, a medical device, or an electric vehicle component, Flex might have built it?
Exactly. They're the invisible engine powering innovation across data centers, communications, automotive, industrial, and health solutions. And they do this across 30 countries, giving customers a truly global, resilient supply chain.
Okay, so now that we know what Flex does, let's get methodical. Sarah, what phase is Flex in right now according to our framework?
Using our decision tree, we check 3 things: capital returns, operating income sign, and revenue growth. First, capital returns. Flex has an active share repurchase program. They bought back $944 million of stock in fiscal year 2026. Second, operating income, consistently positive and growing. $1.368 billion in fiscal year 2026, up from $1.169 billion the prior year. Third, revenue growth, plus 8% year-over-year in fiscal year 2026, with quarter 4 accelerating to plus 17%.
So all green lights?
Mostly. Based on our framework, Flex is in phase 3, mature growth. This means the company has moved past early-stage volatility, has proven profitability, and is now focused on operational efficiency, margin expansion, and selective reinvestment to capture structural growth, like the AI and data center boom.
Got it. Mature growth phase. Now, help our viewers understand. How does Flex actually make money?
We answer 7 key questions. First, core product, end-to-end manufacturing services, from design to delivery. Second, revenue streams, primarily contract manufacturing fees, billed on cost-plus or fixed-price basis, plus design engineering fees and supply chain management services. Third, primary customers, leading global brands in tech. Exact names are often confidential, but they serve top players in cloud computing, communications, automotive, and healthcare. Fourth, customer relationships, multi-year strategic partnerships. Flex emphasizes co-development, getting involved early in product design to lock in long-term relationships. Fifth, geographies, truly global, Americas, Asia, Europe, with manufacturing in 30 countries. No single country exceeds approximately 30% of sales, which diversifies geopolitical risk. Sixth, critical dynamics. It's a low-margin, high-volume business. Typical EMS gross margins are 8 to 12%, so profitability hinges on operational efficiency, scale, and working capital management. Seventh, capital intensity, moderate. FY 2026, CapEx was $633 million, or approximately 2.3% of revenue, relatively asset-light for a manufacturer, with investments focused on automation and strategic acquisitions.
So it's a scale and efficiency game, not a winner-take-all tech platform.
Exactly. Success comes from executing flawlessly at scale, not from disruptive innovation.
Let's talk competitive advantage. Does Flex have a moat, and is it widening or narrowing?
We evaluate 5 Moat sources. First, switching costs, moderate. When a customer qualifies Flex as a manufacturing partner, switching means re-qualifying suppliers, risking supply chain disruption, and transferring IP. Multi-year contracts deepen this embeddedness. Second, intangible assets, low to moderate. Flex doesn't own blockbuster patents, but it has valuable process expertise, quality certifications, ISO medical, and trusted customer relationships. The brand is B2B functional, not consumer-facing. Third, network effects, minimal. No direct user network effects, though there's indirect value from Flex's global footprint enabling regional supply chain optimization for multinational customers. Fourth, low-cost production, moderate. Scale advantages in procurement, automation, and geographic labor arbitrage help. But the EMS industry is fiercely competitive, so margins are always under pressure. Fifth, counter-positioning, low. Flex's contract manufacturing model is industry standard, not a disruptive alternative.
So overall Moat assessment,
narrow and stable. Flex's moat comes primarily from switching costs and operational scale in complex, high-reliability manufacturing. It's not wide like a software platform, but it's defensible in its niche. And with 6 consecutive quarters of adjusted operating margin greater than or equal to 6%, we see the moat as slightly widening as Flex focuses on higher complexity, higher margin programs.
Okay, Sarah, if I'm an investor, what actually drives Flex's growth from here?
We use a 2x4 matrix, new versus existing customers across 7 drivers. Let me highlight the strongest with our traffic light system. Existing customers, new services, AI and data center infrastructure. Flex is positioning as a key supplier for AI power, cooling, and rack solutions. New services for existing cloud customers. This is a major secular tailwind. Operating leverage, margin expansion via automation, portfolio mix shift to higher margin programs, and fixed cost absorption. 6 straight quarters of greater than or equal to 6% adjusted margins show this is working. New end markets, entry into grid edge power, renewable energy systems, and advanced automotive electronics. These are promising but still scaling. Market share gains, winning programs from competitors via reliability and scale. But the EMS landscape is competitive, so gains are gradual. Pricing power limited. Contract manufacturing is price competitive. Flex can only command value-based pricing on highly complex, co-developed programs.
So the growth story is less about disruption and more about execution on structural trends?
Precisely. Flex isn't inventing the next iPhone. It's enabling the infrastructure for AI, cloud, and electrification, and getting paid reliably for doing it well.
Since we classified Flex as Phase 3, mature growth, what metrics should our viewers watch right now?
For mature growth companies, we focus on 6 key metrics with red/yellow/green scoring. Let's score Flex. Metric: current value, score, commentary. Revenue growth, YOY, plus 8% FY 2026. Solid growth accelerating in Q4, plus 17% on data center demand. Operating margin trend, 6.3% adjusted, plus 60 basis points year over year. 6 consecutive quarters greater than or equal to 6%. Clear expansion trajectory. ROIC versus WACC. Estimated ROIC approximately 12 to 14%, green circle. Returns exceed estimated WACC, approximately 8 to 9%. Value creating. FCF conversion. FCF over net income, approximately 120%. Green circle, $1.06 billion FCF on $880 million net income. Excellent cash generation. Balance sheet health, net debt over EBITDA, approximately 1.8 times. Investment grade profile, active deleveraging. Reinvestment rate, CapEx/sales, approximately 2.3%, yellow, moderate organic CapEx, growth funded via acquisitions versus heavy CapEx.
So mostly green lights?
Yes, 5 out of 6 metrics are green. Flex exhibits strong fundamentals for a mature growth company. Accelerating revenue, expanding margins, robust cash conversion, and a healthy balance sheet. The only yellow is modest organic CapEx intensity, which actually reflects the asset-light contract model where growth comes from operational leverage, not heavy capital investment.
Last piece, valuation. Is Flex cheap, expensive, or fair right now?
For phase 3 companies, we prioritize forward PE, EV/FCF, and EV/EBIT. Current metrics, forward PE approximately 14 to 16 times, based on FY 2027 EEPS of $4.21 to $4.51, EV/EBITDA approximately 10 to 11 times, and FCF yield approximately 5 to 6%. Compared to industrial peers trading at 15 to 18 times PE, Flex trades at a modest discount despite superior margin trajectory and exposure to secular AI/data center growth.
So what's the bottom line for our viewers? Buy, hold, or sell?
Our framework suggests buy on pullbacks for new investors, hold for existing owners. Here's why. Strengths: margin expansion, strong cash flow, healthy balance sheet, and exposure to AI infrastructure tailwinds. Catalysts: planned cloud and power infrastructure spin-off could unlock sum of parts value. Strategic acquisitions expanding capabilities. Risks: customer concentration, cyclical exposure to semis, consumer electronics, and execution risk on the spin-off timeline.
So if someone already owns Flex,
hold and monitor the metrics we discussed: adjusted operating margin trajectory, data center revenue mix, and spin-off execution. If those improve, the story strengthens.
and if someone's looking to buy fresh,
Wait for a pullback toward the $130 to $135 support zone, or wait for confirmation of the spin-off timeline. An entry point with a forward PE closer to 12 to 13 times would offer a better risk reward. The analyst average price target is approximately $112 to $145, so current levels near $145 are fairly valued but not cheap.
Powerful analysis, Sarah. So to recap for our viewers, Flex is a mature growth company with a narrow but stable moat, driven by AI infrastructure demand and operational excellence. Metrics are strong. Valuation is fair but not cheap. The call: hold if you own, buy on pullbacks if you don't.
Exactly. And remember, this isn't financial advice. Do your own due diligence. But using a structured framework helps cut through the noise and focus on what matters: margins, cash flow, and execution.
Well said. Thank you, Sarah. And thank you, our Build Wealth Now community, for tuning in live. Drop your questions in the chat. We'll answer a few post-show. If you found this valuable, smash that like button, subscribe, and hit the bell so you don't miss our next deep dive. Until next time, stay curious, stay disciplined, and keep building that wealth. This is Billy Bob signing off.
And this is Sarah. Have a wonderful day, everyone.
Build Wealth Now News is dedicated to research the businesses behind the stock names. Our research are done with artificial intelligence assistance using the best practices in the industry. Please note that investing carries its own risk, and you should do your own research before committing any stock to your own portfolio. This conversation is for educational and entertainment purposes only.